in this video, I'm going to show you how to project a new balance sheet using a simple method called percentage of sales technique. And so we'll be able to do two things. One, recreate the balance sheet, and two, figure out if we actually need to borrow more money in order to do this. So we do have to start off with a few assumptions before we can get started. So I have a balance sheet for Mackenzie Corporation. So this is what happened in this year. And so now I'm going to try and project what would happen if I increase my current sales by 150% or 50%. So my current sales are 200,000. I have a sales increase of 50%. So whenever I want to gross anything up, instead of just looking at the change, then I can just put 150% in front of the number. So that would increase my total sales. So maybe I'll just call that sales increase total. So it's just the 50%, and now we're looking at it at 150% for the total sales, and this is just the change in sales. Now, I also need to know what my profit margin is, or my net income. So if the question doesn't give us our income statement, then we can calculate, or they'll have to give us the profit margin percentage. And then I also need to know what my dividend payout ratio is. So they can either give us the dividends from the current year, or they'll give us the dividend payout ratio if they don't give that information to us either. So now we have all the information that we need to project this new balance sheet. So it's a very easy process. Under the percentage of sales, what we're going to assume is that all of our current assets are going to increase with the increase in sales. So that means cash is going to increase, accounts receivable is going to increase, and inventory is going to increase. So all we need to do is take the 5,000, multiply that by 150% to give me my new cash balance. We'll do that with accounts receivable. 400,000 times 150% to give you your new accounts receivable balance. And the same thing with inventory. So now I can total that up. So I have my new total current assets. So the 7,500 plus the 60,000 plus the 37,500 to give us 105. So I do have a bit of a problem with equipment. So if I actually need to buy new equipment in order to support this 50% sales increase, then I'll increase my equipment 150%. If I can use the existing equipment in order to support a sales increase of 50%, then I won't need to increase my equipment. So this first round, I'll do it assuming that I need to buy equipment. And then the second round, I'll do it assuming that I can just rely on the equipment that I already have. So I'm only increasing this because I'm under the assumption that my equipment needs to increase with the sales increase. So now I can add the current assets with my long-term assets, and I end up with $180,000. Now, just from working with balance sheets, and because you already know the accounting equation where assets equals liabilities plus shareholders' equity, I know my new balance sheet for my total liabilities and equity has to equal $180,000. So those two equal. So I'm going to go through the same process with my liabilities. So I'm going to look at all of my current liabilities, and under this method assume that those are also going to increase with the increase in sales. So my accounts payable is going to increase by 150%, and my accrued expenses are going to increase by 150%. So I'll take 40,000 times 150% to get 60, and 10,000 times 150% to get 15,000. Now, I don't do anything with the notes because this is what my decision is, trying to figure out if I actually need to borrow more money. So I'm going to do this one at the very end. So I'm just leaving that. Now my common stock is just going to stay the same. So I'm going to put that at 100%. Now the reason why I don't change common stock is because this isn't a question about issuing shares. This is a question about borrowing money. So that's why we just leave that at the same amount. Now retained earnings can be a bit tricky to calculate. And so I'm going to open up my retained earnings account. And I'm just going to find out the change. So change in retained earnings. So this is how we would calculate the change all of the time. So you know that you take your net income and then you can subtract your dividends. That will give you your increase or decrease or change in retained earnings. So right now I'm going to try and figure out what my current net income is before projecting what my new net income is going to be with my sales increase. So I don't have the income statement, but I do have this information. I know my current sales is 200,000. And I know that if I multiply that by the profit margin percentage, that will give me my net income. Now that I know my net income, I can take my $12,000 and then multiply that by the dividend payout ratio of 50%, and that will give me the amount of dividends that I paid out. And so then when I add those two together, so 12,000 minus 6,000, that will give me my change in retained earnings just for the current year. And I'm just going to write this down for you. So this net income number was my current sales, 200,000, multiplied by my profit margin of 6%. And that gave me the 12,000. And then my dividends were the net income of 12,000 and multiply that by the dividend payout ratio of 50%. So then that gives me 6,000 in dividends. And then the difference is the change in retained earnings. So now that I know what my change in retained earnings was for the current year, I can go ahead and increase them. So if we have a sales increase, I want to increase these by 150%. So my new net income is going to be 12,000 times 150%, and my new dividends are going to be 6,000 times 150%. So my increase in my retained earnings is going to be $9,000. So now we can take this $9,000 and put it in right here. So right beside the retained earnings. So if you take your opening retained earnings plus the change, then that will give me my new retained earnings. So now that I have all this information, I can work backwards and find out what my new notes payable balance is going to be. So if you just say equals, and then you start off with the 180,000, and then we just do the opposite on the opposite side of the equation. So I'm just going to subtract everything else out of here. I'm going to subtract the 54, the 10, the 15, and the 60,000, and that's going to give me my new notes payable. So I'll just write this down. So I started off with the 180,000. I subtracted the 54,000. I subtracted the 10,000. I subtracted the 15,000. and the 60,000. So all of the accounts, or all of the liabilities and equity that I had balances for. And then that gave me the new balance of 41,000. So if I'm just looking at what my current notes payable was and my new notes payable, I know I would need to borrow money in order to make this 50% sales increase happen. So we can just do the change. So if I just do equals 41,000 minus 15,000, then that will give me 26,000. So that's how much I need to borrow in order to support a 50% sales increase. Now this could also go down. So in some cases, you might actually end up with excess funds. So in that case, you wouldn't have to borrow anything. You'd actually end up with more money and you can pay some of your debt down. So I'll just write out what this is. You will need to borrow $26,000. So it's just this number here, in order to support a 50%, so remember that's our sales increase right up here, a 50% increase in sales. Now let's redo this question, and I'm just going to make one change, and because I have everything linked in my spreadsheet, it's going to be quite easy to do. Let's assume instead that I won't have to buy any more equipment in order for my sales to go up. So if that's the case, if you can just rely on the equipment that you already have, what we would do is just keep this at 100% instead of 150. So you'll see then that my equipment stays the same before and after the increase. Now with everything else staying the same, then what's going to happen is my total assets changed. That means my total liabilities and equity will change. And then if I subtract my retained earnings and my common stock and my accrued expenses and my accounts payable from the total liabilities and equities, I now end up with 16,000. So that's only an increase of 1,000. So if I don't need to buy any more equipment, then I would only need to borrow $1,000 in order to support a 50% increase in sales. So that's the only thing you have to watch out for, is whether or not we are increasing the property, plant, and equipment or not, and the question will tell you.